What's up guys, my name's Davin and welcome to another BullRush Academy video. In today's video, we're going to be taking a deep dive into how Forex actually works. We're going to be covering everything from which currencies are most commonly traded, to understanding pairs, going long and short, spreads, and even rollover fees. If you're new to Forex, don't worry, we'll break it down step by step. And remember, if you want to learn more, head on over to BullRushAcademy.com, our free educational platform where we dive deeper into every aspect of trading. Are you ready? Let's dive right in. Forex involves trading currencies from all around the world, but there are a few heavy hitters that take up most of the trading volume. Here are the top 8 currencies that you'll hear about most often. First, we have GBP, which stands for Greater British Pound, and that comes from Britain. Next, we have USD, US dollar, which comes from America. Next, we have EUR, which stands for Euro, which comes from Europe. We have JPY, which is the Japanese yen, which comes from Japan. We have AUD, which stands for Australian dollar, which comes from Australia. We have CHF, which stands for Swiss franc, which comes from Switzerland. We have CAD, which stands for Canadian dollar, which comes from Canada. And then last but not least, we have NZD, which stands for New Zealand dollar, which, as you might have guessed, comes from New Zealand. These 8 major currencies typically have smoother price movements and are the focus for most traders, especially beginners. While other currencies exist, they often come with a higher volatility, so if you're just starting out, these major pairs are a great place to begin. In Forex, currencies are traded in pairs. Each pair is essentially one currency's value relative to another. So let's break that down. There's the base currency, which is the first currency in the pair. And then we have the quote currency, which is the second currency in the pair. GBP/USD equals 1.300. As an example, here GBP is the base currency and USD is the quote currency. This number tells you how many US dollars it takes to buy 1 British pound. In this case, 1.300 means it costs $1.30 to buy 1 Greater British Pound. Another example would be Euro USD. Euro USD equals 1.4015. It costs $1.40 USD to buy 1 euro. USD CAD equals 1.1181. It costs $1.11 Canadian to buy 1 USD. In Forex, you can buy, go long, or sell, go short. This might be confusing at first, so let's simplify it a little bit. Buying, or a long position, means that you're expecting the base currency to strengthen or go up against the quote currency. A sell position, or a short position, means that you're expecting the base currency to weaken or go down against the quote currency. Imagine you believe GBP USD is about to rise. You'd buy GBP USD or go long. If the pair's value goes up, that means that 1 British pound is worth more in dollars, so you can close your position for a profit. But if you think GBP USD will drop, you'd sell GBP USD, go short. Now, if the pound loses value compared to the dollar, it takes a few dollars to buy a pound, and you'd profit upon closing the position. So now that we know a little bit about what a buy is and a sell is, let's get into spreads. A spread is basically the difference between the bid price and the ask price on your broker's trading platform. A bid is the price at which you can sell or open a short, and an ask is the price at which you can buy or open up a long position. So for example, if GBP USD is quoted at 2.0414 by 2.0418, going long gets you in at 2.0418, which would be the ask, and going short gets you in at 2.0414, which is the bid. The difference between 2.0414 and 2.0418 is the spread. This is often how brokers make a portion of their money. As soon as you enter a trade, you're slightly at a loss due to this difference. Your goal is to have the price move favorably enough to overcome the spread and lock in a profit. Finally, let's talk about rollover, or commonly referred to as swap fees. This usually comes into play if you hold a position past your broker's daily cutoff time. In the US, this would be commonly around 5 p.m. Eastern time, though it can vary. Each currency has its own interest rate. When you buy a currency with a higher interest rate against one with a lower rate and hold it overnight, you'll often earn interest. Conversely, if you hold a position where you're selling the higher rate currency against the lower one, you'll usually pay interest. For example, with JBP, JPY, if Britain's interest rate is 3% and Japan's is 0.5%, going long on GBP JPY might pay around 3% minus 0.5%, which equals 2.5% annualized if held overnight, credited to your account in small daily increments. However, the opposite is true if you go short GBP JPY. You'd pay that interest difference instead. If you don't want to deal with rollover fees or credits, you can close your positions before the daily cutoff. But many traders use this concept called the carry trade to potentially profit from the interest rate differences. And that is the basic rundown of how Forex works. From commonly traded currencies to pairs, going long and short, spreads, and rollovers. We hope this clears up some of the mystery around Forex trading. If you found this useful and want more in-depth lessons, remember to check out BullRushAcademy.com, where we offer step-by-step guides, blogs, and courses to help you become a more confident trader. And be sure to subscribe to the BullRush YouTube channel, because in our next video, we'll dive a little bit deeper into some Forex strategies and what you need to know to start trading effectively. Thanks for watching. Don't forget to like, subscribe, and share, and I'll see you in the next one. Trade, compete, win.